We meet in an hour of change and challenge, in a decade of hope and fear, in an age of both knowledge and ignorance. If this capsule history of our progress teaches us anything, it is that man in his quest for knowledge and progress is determined and cannot be deterred. Because that goal will serve to organize and measure the best of our energies and skills. Because that challenge is one that we're willing to accept, one we are unwilling to postpone, and one we intend to win.
So hi, everyone. Welcome to another episode of the Energy Impact Podcast. Super excited here to host Dan Goldman, Managing Director of Clean Energy Ventures. Dan, welcome to the show.
Thank you, Michael. It's great to be here. Thanks for having me.
Yeah, well, we're super excited to hear about what you're doing now. But before we get into that, maybe tell us a little bit about your background. Where did you grow up, and you know, what led you down this path?
Yeah. All the way back to where I grew up.
All the way back. Yeah.
Well, I grew up in suburban New Jersey, so not that exciting, but had a good childhood, and so I started my career really in the oil and gas industry. I got kind of passionate about it in college, just sort of understanding how this massive industry works, how it evolved over time. And so I started really in the consulting business, and was quickly sent out to Singapore, to Asia, to manage the energy consulting practice there. And so
hold it. So you grew up in New Jersey. You're like, oh, oil and gas is. I mean, if you grew up in Oklahoma or Texas, right, it makes more sense. I mean, connect those dots for us a little bit.
Yeah, it was kind of it was a professor at Cornell who really got me kind of interested in energy, both oil and gas and power, and how the industry works, kind of levelized cost analysis, you know, kind of the financial policy, regulatory side of it. And it just kind of sparked an interest. And so, yeah, after some grad school work in you know, specifically focused on some areas of interest, I decided to be a consultant. And so we moved out to Asia in the early 90s, and I spent 4 years really focused on advising you know, large oil companies, you know, national oil companies, majors, on strategy, organization, investments. And at the time, there was a really huge transition going on, kind of globally, but especially in Asia, where this independent power boom was starting. So private companies were, you know, developing power projects and entering into long-term contracts with governments to sell the energy. And so, you know, while I was a consultant in Singapore, I got recruited to join a company that was a power development company. And it was owned by Bechtel and Pacific Gas and Electric originally, and then it became Bechtel Shell joint venture. And we developed, financed, owned, and operated large-scale energy infrastructure around the Asia-Pacific region. And so I did that. I was part of development of about $4 billion worth of power projects across the region. And then, you know, and that was all fossil power. It was mostly natural gas, but some coal. You know, but then when I came back to the U.S. in the late 90s, you know, and saw what was happening here, I got involved in clean energy. And so in the early 2000s, really started focusing my career on how could you take what you learn from both the global energy industry, you know, which I kind of learned as a consultant, and then how we develop projects in the power industry, and apply that to wind and solar and biomass-based power generation, biofuels, and other things. And so I was fortunate to meet up with two colleagues, and we formed a partnership and started investing with third-party capital in projects in the clean energy space. So, like I said, biofuels, wind, solar, biomass. And we did that for about 4 years. And while we were doing that in the early 2000s, there was a real kind of mad rush by private equity into that space. And so we ended up selling the portfolio and by the time from the time we started to the time we finished, a whole new market had been created, which was private equity investment in clean energy projects. And we were there at the very beginning of that. And I'm glad we hopefully catalyzed that market to some extent. But there was plenty of money flowing into that market. And what I saw kind of around 2006 was there was a lack of capital flowing into technology. And that was going to be really, really important eventually for these projects if they wanted to come down the cost curve and be competitive with natural gas fired generation or diesel fuel or gasoline. And so with other partners, we formed a kind of an early stage angel group called Clean Energy Venture Group. And the idea was to invest really small amounts of our own money in early stage technologies that we thought were promising. We had a lot of energy experience in this group, so we could diligence and mentor and support the leadership teams. And so we've invested in 30 plus companies as an angel group. And that, ultimately brought more people into the group. And it also brought a lot of investors who wanted to co-invest with us. And so over time, the group grew. We started managing third-party money about 8 years ago. And then that led to us forming a dedicated venture capital fund, really as a result of what we saw as an opportunity that was growing in scale. We were seeing more opportunities, we were seeing better opportunities, and we felt like we needed a dedicated fund more than just investing out of our own pockets and with some third-party investors. So that's the origins of Clean Energy Ventures, which is the $110 million fund we're running now.
Absolutely. Well, great. So I'm going to unpack that a little bit before we get to Clean Energy Ventures, because I think there are a couple really important sort of macro events in that trajectory that we don't talk about enough. And maybe the first is sort of the deregulation of power markets, right? Which you were referring to at the very early stages. It's not something that we've talked about a lot on this podcast, but I think is really fundamental as we think about where we sit today and the policy changes that, we may or may not need moving forward. So maybe unpack what that meant, how that felt in that moment as we were shifting from a very utility central command and control type market to the deregulated markets that we have today.
Yeah, I mean, there's so many different waves of deregulation. I mean, in the 90s, it was really about disaggregating, generation, transmission, distribution, and creating a generation market where utilities could buy least cost power. And I think that brought an incredible efficiency into not only the US market, but also international markets. And it created a whole new industry. And now we're seeing the benefits of that because we see wind and solar coming into that market in the same way, where you can be a generator, you can enter now into a power purchase agreement with a corporate or a utility or whoever. So we have a much more liquid market and a much more competitive market to drive costs lower. So that's been a really important feature of the markets, since the early 1990s when PURPA was, effectively put in place. And then, of course, some of the other important areas of deregulation are around things like demand response and behind the meter generation, where utilities have to buy back power. And those have created, kind of this prosumer, consumer new environment. And, that creates a really different grid. It creates different resiliency. It creates the utility that can effectively use distributed resources in new ways. But I would say that our regulatory environment around those things needs to go a lot further. We're really at a very immature state in terms of what utility regulators are willing to accept and how far they're willing to go in terms of support for kind of new models that are going to support this move to a decarbonized grid. So I think we still have a ton of work to do on the regulatory environment. And just as one example of that, at the federal level with FERC, getting like smart grid technologies into the market, grid enhancing technologies as they're being termed now, has been really challenging. But those are technologies, and we have one company, Line Vision, that is very much focused on transmission line monitoring at very low cost. If we want to avoid building billions of dollars of new grid infrastructure and figure out, new technologies that can help manage and use the existing grid more effectively, we need better regulation both at the federal level and at the state level to make sure we implement those things.
Yeah, it's always a hot subject, and I appreciate you kind of moving forward into that the next evolution of deregulation or whatever you might call it, right? And we don't want to get political, but how we effectuate rapid change in a way that sort of brings all the stakeholders along, right? I mean, this is a challenge that all these distributed resources and new climate tech, I think, is struggling with. So that's super fascinating. So you're kind of there at the early wave, oil and gas side, and then you're pretty early in solar and wind, right? I mean, the early 2000s, still a lot of questions around its cost competitiveness, right? So maybe talk us through, I'm sure there are periods of doubt that like, oh, I think it'll work, but,
Right.
walk us through what that was like.
Yeah, well, a funny story is, Jigar Shah, who's, famous, now running the loan program at the Department of Energy. I remember looking at Sun Edison's first project, and I think it was highly economic. It's just the tax environment back then was so imprecise. And so you didn't have a good understanding of how tax treatment would be on, investment tax credits or production tax credits. So it was a little bit of a Wild West environment then. And I think what we tried to do was really focus on projects that were truly economic. Biofuels was, of course, really taking off then, ethanol, biodiesel projects. And so we had a pretty significant focus on that area. But there were a lot of new technologies coming to market, that could bring down the cost curve pretty dramatically. It's just that technology commercialization, that valley of death of building out pilot projects was really challenging. So we stuck really very much on proven technologies, maybe a little bit more expensive, but we knew that they were going to work. And it was really conventional project finance, project equity structures where we had, off-takes and EPC contracts. And so very like what I would call a tightly structured model around that. And so you had to make the economics work or else you wouldn't invest in the projects. Of course, the costs we were talking about then compared to today were radically different, but with the market incentives, they worked.
And economic in a project finance context, right? But still pretty maybe out of market is unfair, but high revenue contracts in order to justify the technology at that time, right? But because those customers, utilities, presumably were sort of willing to support some of that early technology development.
Yes, I think the utility market then was as much a function of renewable portfolio standards that utilities had to meet as compared to today, where utilities can go out and procure solar or wind as a least cost generation option. So we don't need portfolio standards, I would argue, anymore. We have the lowest cost options that are, that are renewable and zero carbon.
But certainly highlights this theme, which I didn't expect to go down in this conversation, but sort of a deregulated market is still sort of somewhat regulated, just the interwoven nature of the different stakeholders here. And I think that sometimes gets lost in this, subsidized or not subsidized discussion. It's just far more nuanced than that and needs to have a much longer term lens, in my view. So you're just hitting on a subject that I'm pretty passionate about. So
yeah, I think it's a great question. And I think one thing, if we try to imagine the future, could we imagine a future where the utility market, where electricity doesn't need to be regulated? I mean, could we go, not or lightly regulated, maybe like the telecoms market is lightly regulated? Could we have trading regimes and grids that operate effectively independent from regulation and protect consumers in the way they need to be protected? That would be an amazing thing. I think there's a lot of technology, that's coming to market now that could enable that kind of environment. And, we saw a radical reduction in telecoms costs and much greater degree of service and options after deregulation. So the question is, could we have a similar type of environment for electricity?
Yeah, no, really, really interesting. And you could certainly argue that cell phones are as much a human need now as electricity, right?
Right.
For better or worse. So really great. Let's come back to that sort of evolution. You were in sort of project development land, and project finance, and ended up sort of transitioning more early stage. Maybe walk us through the thought process there. That was just a market opportunity or something that you saw that needed to evolve moving forward, or dumb luck, or some combination of the three.
Yeah, maybe dumb luck is the best explanation. No, I think what I saw was a real need in the market. I think if we weren't going to get new technologies commercialized sooner, and I think this still holds true today, we weren't going to bring that cost curve down, and we weren't going to get widespread adoption. And so, we started really seeing some amazing technologies, coming out of university labs, coming out of incubators and accelerators. But there was very little funding for that early stage of the market, because most VCs that were investing in clean energy and climate tech back then didn't want to take that early stage risk. They also didn't have the capacity necessarily to advise and mentor teams, leadership teams in these companies. And so that was something we really wanted to do. We felt could be very helpful, kind of carve out a niche in the market. So in doing so, we felt like we brought technologies to market that otherwise wouldn't necessarily have gotten there, and got them funded. I mean, we didn't invest very much money in these 30 or so companies, but the companies themselves went on to raise, 500 million plus of venture and project capital. And that's really a result of kind of seeding them to the stage where they were ready for traditional venture capital. Now, I think the ecosystem is much more sophisticated and mature and evolved to having philanthropic capital and seed capital and angel investment and early stage venture and late stage venture and growth capital. So we have a really, I think, mature market today in terms of financing that wasn't really existing back then. And we just wanted to fill one of those holes, which was getting things out of the lab, proving them and getting some customers to start scaling.
Yeah, that valley of death, right? I mean, so maybe explain a little bit today where you're focused in that company age or company status for clean energy ventures.
Right. Yeah. So we leveraged what we had been doing for since 2005 when we formed the fund, and the idea was to really leverage our success in that strategy. We had a number of exits, a lot of companies who grew to scale. So we learned a lot over the years as to what worked and what didn't work. And we had a really low failure rate, which was kind of interesting. We attribute that to always being quite focused on technology diligence and understanding what's differentiated about a technology, what intellectual property there is, and how that brings value to the company. So on the back of that, we established the fund really to invest at the early stage, so seed and Series A rounds, and to reserve capital for follow-on rounds as well. And our focus is on climate tech companies that can have a material impact on greenhouse gas emissions. So we use a very specific metric called, which is 2.5 gigatons of greenhouse gas emissions reduction cumulatively over a period from today to 2050. So we don't look at kind of an annual number, because when we invest in a company, it may take 5 years for them to get to market or scale. And so it's really kind of this S curve that we have over which a company scales exponentially and then more slowly when they reach maturity. And so we thought it would be more appropriate to use a long-term gigaton level metric. And so every company we invest in goes through a process of evaluating their emissions reduction through a simple emissions reduction calculator, which is on our website, publicly available. We want more people, we want everyone to use it, quite frankly, because it helps guide investments into things that can be the most impactful. So that's kind of one of our key criteria. The other key criteria is to invest in companies that can grow to scale, be financially successful, and offer the fund top decile returns, risk-adjusted returns. And so we have these two metrics, fundamental metrics that, they're not in conflict with one another, because if you have a company that's financially successful and can grow to scale, it's going to have climate impact. And if it can have climate impact, we think it's going to grow to scale. So those, in addition to obviously not investing in sort of capital intensive businesses, investing in top tier leadership teams, investing in things that have a strong competitive advantage, sustainable competitive advantage, and where we can also be helpful to the company. Those are some of the most important criteria that we use in terms of assessing opportunities in the fund.
Great. Yeah, a lot there. So let's pick apart some of that. So you described sort of that S curve, that technology maturation curve. Where, when I think of seed, Series A, sort of the very far beginning of that curve, where would you say you guys like to exit? Right? I mean, is it still kind of in that early adoption? Maybe some follow on Series B or C, but you're looking to, maybe sell your stake at that point? Or are you truly along to support that full maturation to actually achieve those, forecasted carbon reduction goals?
Right. Yeah, we're probably not along for the full, 20 or 30 years, because we're a fund like most venture capital funds. So we have a pretty standard term in terms of the fund life. And so we typically invest at that first round with an eye toward a 3 to 6 year maturity and opportunity to exit. So we're looking at a company that, maybe at the time we're investing could be pre-revenue, but has a large market opportunity. Or in many cases, they have early revenues, $1 million or $2 million of revenues. And so our goal is to help them get to 20, 30, 50, $100 million of revenues in that period, get to, EBITDA positive, and look for strategic exits, or now in the current market, SPACs or other types of opportunities. And so really, we're pretty traditional, I think, in terms of the venture model, in terms of how we think about exits. But we certainly, look at the companies through a lens of, if they exit in a 3 to 6 year period, will that also help to accelerate their adoption rate? Because in many cases, we have companies that historically have exited to strategics. And so, if you have a really strong technology and you sell it to a strategic, then in many cases, the strategic might be able to devote more resources and be able to deploy that technology faster. And so we see that as, having significant greenhouse gas emissions reduction benefits if you can exit, as the company is scaling, and a strategic will really accelerate their growth to market. An example of that, so we had a company, this was before the fund, but called 7AC Technologies, which was in the heating, ventilation, air conditioning business, and really innovative solution. And it was acquired by Emerson. And we saw Emerson as really helping to accelerate their growth, both as an investor and then as an acquirer. So that's an example of where strategics can really help the companies.
Yeah, no, that makes sense. So do you follow then, if you have this sort of underwriting criteria of long-term emissions reductions, do you then follow that company through that life cycle? Or, post-sale, it's probably tough to, stay involved, especially if it's combined with a strategic, right? So, how do you think about continuing to really track that, based on the underwriting criteria?
That's a great question. And it's something we're trying to work out right now as we start to see kind of exits emerging in the fund. What are we going to do after a company goes off and is part of another company? Can we still create that relationship with the company and ask them to assess performance? But I don't think we've figured out any clear, easy answer to that, but it's certainly something we want to try to monitor, because it's very helpful for us for continuing to invest in this space to understand what happens after exit. And so, a lot of times we know the acquirers really well. And so I think there is an opportunity to continue that relationship and ask them, even write it into the documents, perhaps, that they'll continue to report to us on emissions reduction.
Yeah, I don't know many lawyers that would like that term. But, it's in goodwill. I think you could probably get there. Have you talked about maybe moving, obviously not under the existing fund, but moving capital investment sort of further along that adoption curve? There's this sort of trade-off between maximum disruption and maximum opportunity versus perhaps a risk-adjusted, more of commercializing technology, hardware and software, and sort of solving that valley of death. Is that something that you've talked about or thinking about?
Yeah, I think we try to do both. We want incremental solutions that we think can be impactful, but we also want some game-changing solutions. And so one of the areas we've had a particular focus is in solar tech. Solar obviously has gotten incredibly low cost now, but there's so many more things we can do to bring the cost even lower. And so we have two solar tech companies in our portfolio. One is really about reducing the cost of wafer production, monocrystalline silicon wafers, bringing the cost down and improving the efficiency. And another is in the coating space on density, which provides a coating that allows more absorption of light and therefore radically improves the efficiency of a panel. So those are things that are game-changing. They're pre-revenue, but once commercialized could really see significant adoption and have material impact on the market, both from a cost and of course an efficiency standpoint.
Yeah, so maybe we can dive in and talk a little bit about your criteria, right? Your filtering process. How do you evaluate the likelihood that these companies can achieve that commercialization? And when do you know it's not going to work? And maybe what mistakes or lessons learned that you could impart to our audience about pitching investors for this kind of business? Yeah.
Right. No, that's great question. Well, so we dive very deep into diligence, and a big part of that diligence is not just understanding the technology, but understanding the route to commercialization. And so we'll talk to industry players who might be customers, might be partners, and say, how would you view this technology? How much testing would you need to do on this technology? What would allow you to be like a scaled adopter of this technology and either enter into purchase orders with the company or partner to build a plant or whatever the situation demands. And that's extremely helpful for us because we can then understand what milestones the company needs to meet over time to get to that point. We can understand how much capital they need to get to those milestones. And so we'll oftentimes, as part of this discussion with industry players, work backwards from an exit and think about, okay, the company needs to be here in terms of exits. They need to have this level of revenues, this amount of production capacity, both financial and technology. And then, what are the milestones they need to meet to get to that point? And we'll also talk to other financial and strategic investors to understand along the route to those exits, what kind of milestones would they be looking for in order to invest, say, growth capital in the company. So it's a whole kind of staged approach to thinking about how does this company evolve over time, and it has to kind of hang together. And then, obviously we'll go deep on the technology to understand how it works. We'll understand what competitors might be out there. what kind of intellectual property protection do they have? What does the leadership team look like? And that's where we use some very extensive experience. We have an outside leadership expert from a firm called Dialogos that supports our evaluation prior to investing, and then often works with our leadership teams and our companies after we invest. And so build out of that leadership team, understanding the culture, understand how we can be helpful to them is a really important part of our assessment.
And so I guess one of the things that jumped out at me as you were saying, talk a little bit about your sort of sourcing criteria. Are you, is it more of a demand pull? You're talking to all these customers and you say, oh, this solar panel process needs to be improved, or kind of supply push people, you're having new companies come to you and say, would you like to invest? And you say, great, let us take some time and see if it makes sense.
Right. Yeah, it's both. So the latter part is just the inflow, which is quite extraordinary now, unmanageable, I would say. We've been doing this for over 15 years, so we are somewhat known in the market by entrepreneurs, and people know how to find us. And so we do get an amazing amount of very high quality deal flow that comes in, and we ask all of the entrepreneurs to fill in a screening form so we can really very quickly understand if it meets our criteria for investment. And that goes to the greenhouse gas emissions reduction. It goes to the scaling and the time frame, intellectual property, the sustainable competitive advantage. So we ask entrepreneurs to fill in a screening form. The other part of it is actually the really interesting part, which is we tend to do detailed roadmaps of different subsectors in the industry. So we'll look deeply at hydrogen. I mean, we've been looking at hydrogen deeply for 6 years now, right? We did some road mapping. We tried to understand, different sectors for hydrogen, like what would the use cases look like for hydrogen in transportation? What would the use cases look like for hydrogen in storage as a storage alternative? What would they look like for industrial applications? And looked at economics, looked at policy, looked at finance, looked at technology. And on the basis of that, it guided what kind of opportunities we want to invest in hydrogen. And that led to us making an investment in the hydrogen sector based on our conclusions there, which were much more geared toward industrial uses of hydrogen than alternatives. And so our roadmaps instruct our, what we'll go out and look for and how we'll evaluate our deal flow. We've also done roadmaps on storage multiple times, on water technologies, on carbon to value, on vehicle to grid, and a bunch of other things. So these are really important areas. We constantly evaluate what do we need to be smarter about? What do we need to learn? Deep thinking time is really, really important for all of us. We don't have enough of it, but that's the kind of thing we want to do during our deep thinking time.
And are those that you mentioned some of the more immediate opportunities or areas that you're focusing on, or can you share some of those that are most prevalent as we sit here today?
Yeah, well, we've made investments in hydrogen. We've made investments in storage, not necessarily conventional electrochemical, but some interesting pieces of the supply chain. And then we've looked deeply at carbon to value, and we're contemplating investments in that space as well. So that's certainly one that we've been focused on recently. We've also looked closely, I wouldn't say we do it in roadmap, but looked closely at kind of circular economy opportunities. And we ultimately made an investment in Nth-Cycle, which is an electro extraction process for recovering minerals and metals from end-of-life batteries, e-waste, electronic waste, but also mining, ores, and tailings. So really broad application, very advanced technology that's 70% more efficient than conventional like hydro and pyrometallurgical recovery techniques. So that was certainly circular economy was something we're really interested in, and we found a great opportunity there. And then I should mention the other thing is we spent a lot of time with accelerators and incubators, kind of talking to strategics who are involved with them, and also the accelerators and incubators themselves to really understand kind of what they're seeing, what kind of companies are, coming into their organizations, and and also getting involved in some of the programming where we can be helpful.
That's that makes a lot of sense. How do you parse apart? I guess let me say it this way. It strikes me that one of the differentiating things, one of the challenges in the energy space is that sort of technology component, right? So there's a lot of software, VC funds, and Series A and seed money. I mean, that is a huge ecosystem. But the people in that ecosystem have trouble sort of peeling apart the regulation and the technology specifically. How do you really peel apart non-commercial technology to see if it can actually achieve 70% reuse, and it's never been done before, and every founder believes theirs is the one that changes the game, and it would be great if that were the case, but obviously everyone can't reach that commercialization. So how do you think about that risk and approach it with optimism, but maybe tempered optimism?
Yeah, I mean, you have to be careful, right? Of course, we're investing at a pretty early stage, so there will be things that don't work, maybe at all. There will be things that don't work the first, second, and third time, or maybe they work, but instead of 70%, they're 50%. And so we'll kind of stress test the technology and the models and see, well, what would happen, if this is not as good as they say it's going to be, or costs double what they say it's going to be, and what are the risks around that? And so, obviously there's no definitive fact-based answer to this, but we try to get as smart as we can and talk to as many experts as we can in the industry. And of course, I think the other thing that is quite unpredictable in a lot of spaces, take lithium, for example, direct lithium extraction technologies, which we've looked at a lot, is what's the competitive intensity of that space? So not only might you have a lower lithium extraction technology come along and displace you, but you might have batteries that don't need any or need a lot less lithium today. So could we move to batteries that have a totally different metallurgical makeup, and that would disrupt a technology that you think is going to be used for a long time in a market that is really growing fast. So I think things like that we try to evaluate the risks as best we can, but venture is a risky business, so you inevitably are going to be taking some risk.
Yeah, absolutely. And maybe sort of continuing down that path, where are some of the holes in the capital stack or in the financial markets that you think still exist today that we could use more investors? I think there's a lot of competitiveness sort of bubbling up now around this Series A and seed, because it's at least a smaller check size. But
right.
How do we continue to commercialize some of these new technologies?
Yeah. Well, Michael, I mean, I think what you said earlier was really accurate, which is, there's a lot of investors in the space who are looking at software solutions. And maybe that's just because the background, coming over from tech is more geared toward that. But there aren't that many investors who are willing to do deep, hard tech, science projects. And that is a whole different level of risk, and there's just not a lot of capital at the early stage to do that. There's more obviously coming into the market. I think we're fortunate to have partners like Breakthrough Energy Ventures and the Engine, and a few others who are willing to take hard science risk. But there's an awful lot of capital flowing into software, and that can be very helpful, but it maybe is limited from our perspective in terms of the magnitude of greenhouse gas emissions reduction. So, and then the other part of it is that most of the capital coming into the space is really growth oriented. So there's still not a huge amount of capital at the early stage. And increasingly the growth capital is wanting to write larger checks. So even Series A rounds, which are maybe in the $10 to $15 million range, might be too small for a lot of the climate tech investors these days, who are looking to deploy 30, 20, $50 million in a company. And then, of course, I think what we're seeing increasingly is more private equity focus on this space. So we've seen KKR and TPG and Apollo and General Atlantic and sovereigns like Temasek, all enter the space writing very significant checks, sometimes buying companies or buying control stakes in companies. And I think that growth capital is really important because not every company is going to go public or go to a SPAC. So having alternatives for significant capital, for that growth stage is fantastic. And we're going to need that as the companies mature.
Yeah, no, that's you hit on kind of all the baskets, right? Maybe the only one is the policy coming full circle again, unintentionally, but the policy component of this and how tax incentives or direct investing or export guarantees and other sort of bank structures can maybe supplement that as well, right? So you mentioned the private and infra, you mentioned the public markets, and the government is the third leg of that stool.
Right. Yeah. No, it's a great point. I mean, ultimately, there needs to be a lot of project capital and a lot of projects being built, whether those are just straight wind and solar or other types of renewable projects, or building distributed energy resources and storage. But having loan guarantees, having government financing, and also there's a ton of middle market lending, green bonds. So there's a very, very ripe market and very competitive market in debt right now. And I think that's critical for us to cost effectively get steel in the ground, whether that's building, scaled hydrogen projects, like there was a $40 billion project announced by an industrial gases company in Louisiana. How is that going to be corporately financed? There's a lot of debt in the capital markets right now for financing projects like that. So I think, yeah, and we do need a lot of government support, whether that comes at the state or federal level. Federal level has obviously been really challenged from a legislative standpoint, but hopefully we will see an infrastructure bill, and we'll see more support for project investment.
Yeah, no, it's lots of tools out there, and part of a maturing market, right? I mean, there's so many places. It's such a massive problem. There's so many places that we need to improve and move forward. Really makes it fun, I guess, at least for me. So as you think about these roadmaps and some really interesting holdcos that you have, what does the future look like, for you, for Clean Energy Ventures? What, if we're having this conversation 10 years from today, what are we talking about?
Yeah, it's great. We try to get the crystal ball out and brainstorm every once in a while to think about where we should be heading, kind of skate to the puck type of analysis. But I do think right now there is somewhat of a US-centric view of opportunities within the financing community here, and the international market, I think, presents a lot of opportunity. And more importantly, if we're going to address climate change, we do need to focus on emerging markets. And so, one of the things that we're conscious of is, if we look at places like sub-Saharan Africa, if we look at parts of developing Asia, we need to figure out how to stop installing diesel gensets, because we have an unreliable grid in most places that has outages from 8 to 12 hours a day. And so we need to think about, how do we fund technologies, how do we fund companies that can address that challenge, because that is where a lot of growth is coming from. And if we don't do something about it, it will all be fossil powered growth. And so our ability to address climate change depends on introducing technologies to emerging markets. We have one company called Spark Meter, which provides a metering solution as well as digital solutions to distribution utilities as well as microgrids. And so what they're trying to do is help the grids get a lot smarter so that they can have less outage time, and they're metering their customers. And that can dramatically reduce the need for diesel genset backups. So we're super excited about that, but that's just one example of a company that is working to address emerging markets. And we need, a lot of technologies to, move leapfrog their existing roadmaps and get them to a decarbonized state much more rapidly than they are now. So we really would like to see more focus by US investors and European investors on emerging market opportunities. And that doesn't necessarily have to be investing specifically in the emerging markets, but it's really trying to make these technologies available to developers and governments and utilities in emerging markets.
That's such a great point. I'm so glad you brought that up, because I think it's so easy for us living here domestically to forget about the demographic and just usage trends, right? If you have exponential demand growth and then exponential demographic growth on top of that, I mean, everything we do here is almost not for naught, but is sort of immediately ruined on the other side of the globe. And maybe the one area I'd push back is we really do. I mean, those are countries that really do need hardware, physical investment in the countries, and they need the software to enable that as well. But it induces a whole other host of challenges, right? I mean, sovereign risk and forex risk and whatever else. Super fascinating. What are the next steps there? I mean, right? How do we go about that?
Right. Well, we need obviously, like you said, you need hardware, you need solar and renewable installations there. That's what kind of many of the microgrids are doing. And quite frankly, that's what a lot of distribution utilities want to do, because for their kind of antiquated grids, if they can have distributed energy resources, it provides a lot of grid support. So that's an easier thing for them to do than building a central generator coal plant and attaching it to the grid and trying to use distribution wires that can't take capacity. So there's a real opportunity. And again, this is where SparkMeter, through their hardware and software solutions, can come in and play a really important role in metering and data analytics around what's happening on distribution utility grids. But there are lots of other companies who are, either installing the solar or pay-as-you-go solar, lots of really interesting models in those markets, but not enough capital flowing there quite now.
Yeah, well, sounds like an opportunity for a future fund.
Right.
Well, we're running a little bit low on time. Anything else that we covered a lot, so I appreciate you kind of coming with me on that journey. Anything else that we should talk about or that you think is relevant that we didn't cover?
No, I mean, just excited to see, again, like when we started in early 2000s, there was a very immature ecosystem, and the fact that we have such a robust and end-to-end financing ecosystem, but also an incredible community. I mean, we have, people in the community who have created really interesting aggregation of people from kind of all walks of life, really trying to focus on more diversity, equity, and inclusion in this market, which is an area we are very focused on. We have about 45% women-led businesses. We are aiming to have more BIPOC-led businesses, but it's a real focus of our fund. And also just working on the ecosystem to improve diversity in what has historically been just energy generally a very white male business. So I think that's a really important area for us all to try to focus on. It's going to take the entire community to help add more diversity in.
Yeah, and that's a subject we could probably spend another hour on or more. But it's an important one. So I appreciate you bringing that up, and what a great note to end on. So Dan, certainly appreciate you coming on and looking forward to following your continued success.
Thanks, Michael. It was great to talk to you today.
Our leadership in science and industry, our hopes for peace and security, our obligations to ourselves as well as others, all require us to make this effort, to solve these mysteries, to solve them for the good of all men and for the progress of all people.